Good afternoon, everyone. I would like to begin by acknowledging and paying my respects to the First Nations people for the lands on which we all are gathered. For me, here in Sydney, I acknowledge the Bedigal people of the Eora Nation and their continuing connection to land, sea and community, to their elders past, present and emerging. Today is the first of a series of talks on the future of fintech presented by Dr. Anton Didenko and Joni Pirovich. Dr. Didenko is a research fellow at UNSW Sydney, specialising in banking and finance law. He holds several degrees from Russia and the UK, including a Doctor of Philosophy from the University of Oxford. He is a Russian qualified lawyer with over 10 years in-house experience at a major commercial bank and was senior associate at a London law firm. He is recognised as an expert in financial regulation and FinTech RegTech, and is the general editor of the Cape Town Convention Journal. After his presentation, Anton will be interviewed by Joni Pirovich, Special Counsel at Mills Oakley, specialising in tax, blockchain and digital assets, with exciting things in her title such as digital currency exchanges, token offerings and tokenomics, with expertise in structuring technology consortiums as well. She is a fellow of the Blockchain Australia and co-founder of Digital Law Association. We encourage you to ask questions throughout the session by using the Q&A function, which we set on the open, so you can also chat through that function as well. Anton, now over to you. Thank you for sharing your time, your insight into the trends to watch in FinTech. Thank you, Anton.
Thank you, Marina, for the introduction. Thank you, Joni, for joining us today, and thank you to all the participants. I was asked to prepare a short presentation focusing on the future of FinTech and the law and regulation in this space. So today I'm, despite my practical practitioner banking experience, I'm putting on my academic hat to focus on the most recent FinTech research produced by me and my colleagues. And I'd be particularly interested in your thoughts, Joni, as a practitioner on the three topics that we cover. And I have to say at the very beginning that the speed of change in the FinTech space is extraordinary, and the topics that seemed cutting edge just 2 years ago are already out of fashion. But one thing I believe remains unchanged, that is the fact that the law keeps lagging behind developments and technology. Now, that's for sure. There will be links to the relevant research articles on the final slide if you are interested. My wife tells me they're really good, or at least good for treating insomnia. So if you suffer from insomnia too, they might help you as well. Now, for this session, I have chosen 3 very different topics, and each for a specific reason. The first one focuses on payments and money systems, which are currently undergoing the biggest transformation in decades. There is a lot of change going on, but not all changes are equally impactful. Australia's enhanced regulatory sandbox is the second, and I think very timely topic, because the new Sandbox regulations in Australia came into force just 3 weeks ago, and they are aiming to reanimate, for the lack of a better word, our notorious sandbox that simply failed to fulfill its objectives. And the third topic is fintechs, very broad one, fintechs and cybersecurity. I've chosen it for 2 reasons. First, we're now at the beginning of an international trend towards implementation of bespoke cybersecurity regulation in finance. And second, perhaps more importantly, more and more data changes hands in the financial services sector. And the developments in open banking will further facilitate this process. And add to this the statistics that say that for the past 4 years, finance has been the most attacked industry globally, and you can see that this creates absolutely unique challenges for fintechs that I will discuss later. Now, moving on to the first topic. Now, the research on the evolution of payment systems took me and my colleagues at UNSW, Hong Kong University and the University of Luxembourg 2 years of constant rewriting because of incredible speed of changes. We analyzed the impact of various technological disruptions in the payment sector, and the status quo today, I think, is truly unique. We are now in the middle of a perfect storm of 3 catalysts, causing a fundamental reorientation of domestic and international monetary and payment systems at the same time. So these are the Facebook's Libra, China's central bank digital currency, known as DCEP, which stands for digital currency / electronic payment, and finally, the COVID-19 coronavirus pandemic. Now, these 3 catalysts are very different from all the previous disruptors for 3 reasons. First, all 3 are operating concurrently at the same time. And second, all 3, for the same reason, are mutually reinforcing. So developments and regulatory changes affecting one will often directly affect the others. And third, crucially, each catalyst is likely to have a systemic effect on domestic and international payment systems. Now, we focus on these 3 catalysts in our research because they are easily the biggest disruptors today, overshadowing the previous innovations. Initially, true, Bitcoin was considered to be a major disruptor. Technologies implemented in Bitcoin gave rise to multiple projects to develop stablecoins, that is, cryptocurrencies linked to real-life assets or fiat currencies, and also literally dozens of studies and pilots of so-called central bank digital currencies, or I prefer the term sovereign digital currencies. But only Facebook's announcement of Libra in the middle of 2019, that is the cryptocurrency combined with a global digital payment system, was the first real catalyst of sufficient scale and potential to trigger immediate regulatory backlash. The problem is that Libra was promised initially in its first iteration to intrude into the traditional preserve of sovereigns, the creation of currency. And of course, it was likely to provoke central banks to protect their turf, so to say. And so Libra led central banks to rethink their approach to sovereign digital currencies and to hasten these projects. But the sovereign digital currency projects, or central bank digital currencies, if you prefer that term, similarly existed for years. Some, by the time of Libra's announcement, had managed to fail even. But only a sovereign digital currency launched by a major economy has the scale to disrupt payment systems globally, and clearly the most significant development would be the launch of a major economy sovereign digital currency, such as China's DCEP project, which, by the way, was announced literally a few months after the Libra first announcement. However, speaking of China's project, trials of this digital currency did not occur until the third catalyst, the coronavirus, prompted China to begin transforming its domestic monetary payment system. So you can see one catalyst affecting the other, and so creating a chain reaction. So currently there are live trials of the DCEP project underway in China, and potentially in the long run, the most significant potential sovereign digital currency would be a digital dollar, digital US dollar. But that is still down further down the line compared to the DCEP. As for the future, well, I'll just introduce some of the preliminary conclusions we make in our paper. There are different ways in which payment systems are likely to evolve, but we expect hybrid models involving partnerships between public and private sectors to emerge in the wake of the 3 systemic catalysts. And so we think that in these hybrid models, monetary arrangements will be dominated by central banks, particularly central banks of major economies like China, the US, and so on. And the private sector would be involved in various payment configurations. And so in a sense, this hybrid sovereign digital currency model will merge monetary and payment systems in many cases. While there are different ways to handle it on a global, international level, we could foresee globalization in the form of a common technological system of money and payments worldwide, but at the same time, we could foresee further fragmentation of the global monetary and financial system into competing currency blocks. And frankly, the latter, that is competition and fragmentation, seems more likely. And one of the challenges here is that the sovereign digital currencies are likely to be more resilient to international regulatory harmonization compared to stablecoins like Libra, because the objectives of central banks which have a sovereign digital currency are likely to conflict with those central banks that don't have one. But however these projects will proceed at the international level, it's clear that we will see more and more monetary competition through major economies, sovereign digital currencies, and it will be the defining development of the next decade. The second topic I wanted to briefly introduce is Australia's enhanced regulatory sandbox. If you have been following the headlines and maybe if you had a chance to take a look at the new regulations, you know that they came into force on the 1st of September this year, just 3 weeks ago. And the expectation is quite high. As far as I can tell, the expectation is that it will bring a lot of benefit to the domestic fintech sector. At least this is how I interpret the words of our fintech minister that you can see on the slide. The underlying rationale for the reform is basically to revise the existing sandbox. Well, the previous sandbox, because the existing one the sandbox regime has already changed. So we live with a new regime for 3 weeks already. But the sandbox regime we had before had been largely unsuccessful. If you look at the statistics, this is the latest progress report of ASIC's Innovation Hub that I was able to find. Unfortunately, I couldn't find the more recent version on ASIC's website after that, but frankly, not much changed. So over almost 4 years, literally 3.5 years of operation, the regulatory sandbox one version of 1.0 had attracted only 7 firms. And on top of that, I think it's fair to say that it earned a certain level of notoriety among academics in particular, who have been trying to figure out the secret of this poor outcome. Perhaps due to low numbers, the most recent statistics found in ASIC's annual report didn't even include the number of sandbox participants. Well, because it was really embarrassing to mention 7 firms, I suppose. And here's a quick timeline of Australia's regulatory sandbox, which was and remains managed by ASIC, both under the old and under the new regime. Well, you may think, so what? It was just 7 firms in our sandbox for 3.5 years. Should we really care about this? But I think the question of relevance, the answer to the question of relevance really depends on how competitive we want to be as a country, as a fintech friendly country in the long run. Our sandbox is certainly not the only one with few participants. But if we compare these numbers to the leading fintech sandboxes overseas, then our numbers are abysmal, frankly abysmal. For example, the UK sandbox has already accepted 6 cohorts of fintechs, each with more than 20 firms on average, I think close to 30. And the Hong Kong Monetary Authority has had over 150 fintech trials in the sandbox. And if that wasn't enough, all of our key regional competitors have recently modernized their own sandboxes. For example, the Monetary Authority of Singapore has launched Sandbox Express, sort of a fast track parallel sandbox process in addition to its standard sandbox. We might discuss this if we have the time, but the key outcome for me is that our competitors are trying to do their best to improve. So the two things we should bear in mind, I think, is that ASIC Sandbox was among the world's first. It was launched in 2016 alongside the UK, Singapore, and Hong Kong sandboxes. And so since everyone is revising their approaches, we have done so. The question is, has the revision been useful or successful? And the second point is that ASIC designed its sandbox very differently, the original sandbox very differently. There was no application process, there was no screening of prospective applicants, and this original design attracted a lot of attention, regardless of the number of participants. But the low numbers then led some commentators to conclude, understandably, that perhaps the low numbers were the result of this unusual design. Since I'm wearing the academic hat today, Joni, I would be interested in your practitioner's view after my presentation on regulatory sandboxes. But the academic literature considers regulatory sandboxes basically a standalone type of regulatory strategy for fintech, sharing a certain number of common features. I would briefly summarize them as follows. First, sandboxes create a controlled and supervised environment where innovative businesses can test their business model. Second, this environment is restricted in a number of ways, such as threshold limits, maximum time during which you can make your test or to remain in the sandbox. And third, the relevant tests are carried out with involvement of real consumers rather than, say, using dummy data. So the sandbox model we had until 3 weeks ago it seems quite odd. On the one hand, it ticked some of those boxes, that is testing with real life clients or having certain restrictions. On the other hand, it had proven difficult to explain as a sandbox, given some of its specific features. For example, some commentators have argued that the essential characteristics of a sandbox are the existence of an interactive regulatory environment, a dialogue with the regulator, and there was almost nothing of the kind in the Sandbox 1.0. And also, some have favored some kind of flexibility provided by the sandbox for innovative businesses. And frankly, the original sandbox was rather prescriptive. It was based on a set of fixed and non-negotiable parameters. And as a result, at least in the academia, some authors suggested that the sandbox or fintech license and exemption, it was formerly called, was inconsistent with the logic that underpins the sandbox approach. And some simply concluded that the license and exemption was not a sandbox in the first place, fair and square. Now, what about the enhanced sandbox? Has a lot changed? Well, the enhanced sandbox is pretty much an expanded version of the previous model, just with fewer restrictions. For example, it offers a much longer testing period, 24 months instead of just 12. It admits new types of activities such as crowdfunding services or provision of credit. But the enhanced sandbox, just like the original license and exemption, follows what I call non-authorization model, where participants do not need to apply for approval. They only need to notify the regulator that they wish to make use of the sandbox. And one of the perceived benefits of this approach is that the regulator doesn't really have to assess whether a certain technological solution is sufficiently innovative or not. And really, the sandbox model is quite unusual from the international perspective. Almost every other sandbox around the globe uses a straightforward application-based system. But I think the problem really is not that we have a different model. The problem is that the implementation of this model has been inconsistent. So on the one hand, there is no application process. On the other hand, participants need to submit a 30-day advance notice before accessing the sandbox, which strongly suggests that ASIC would actually review the notice and may even prohibit entry into the sandbox, although it doesn't really have to do it. In addition, ASIC may terminate one's access to the sandbox at any time during the test if it thinks that the relevant service is not sufficiently innovative. And to me, that is just bizarre. In almost any other sandbox around the globe, if you have been accepted as a fintech into the sandbox, then you don't need to worry that what you are doing is not sufficiently innovative. Because the regulator has already reviewed your application and has approved your participation. But here in Australia, we don't really have an application process, so only notice to ASIC is required, and ASIC does not have to review those notices, but may still decide ex post that the service was not innovative after the fact. And potentially this may put our fintechs in a worse position compared to fintechs in overseas sandboxes. So what are the lessons for the enhanced sandbox that we have now, that we've had for less than a month? Well, our model has not really delivered. So it currently has zero export value. Some of my colleagues in academia have argued that our sandbox model should not be exported to other jurisdictions because there's very little interactivity going on. There is no application, no ongoing information sharing with the regulator. And I think strategically, one of the bigger issues in terms of sandbox design is that our non-interactive sandbox design is problematic because it sufficiently hinges on the ability of the regulator to predict how fintech will develop in the future. There is no application process, no ongoing dialogue, no flexibility in modifying the sandbox parameters. And so our sandbox is really a solution waiting for a problem. So if the prediction for about the problems is correct, then the sandbox works. If the calculation is incorrect, then there is no demand and the sandbox becomes useless. And this is exactly what happened with the original sandbox. So I think that the most logical solution would be to ditch the current non-authorization model and really switch to the same sandbox format that the absolute majority of other jurisdictions are using. That is the model based on individual applications. It will definitely be less confusing and more easily understood by the end users compared to the current partly hands-on and partly hands-off regime. And I understand that our government may not like the idea of having the same thing as everybody else, because currently it's our selling point. We have a different sandbox model, but I think it's more important to have a sandbox that is easily understood by fintechs. So perhaps clarity and certainty should be the driving factor, not the desire to be different. And my last bit is focusing on the paper that was commissioned last year by the European Central Bank. And it was really the first exploratory research about the future of cybersecurity regulation in the financial sector internationally. So this slide shows the total number of recorded and publicly reported cybersecurity vulnerabilities by the end of 2018. And as you can see, during the period of 3 years, just between 2016 and 2018, the number had grown massively. In fact, just in those 3 years, there were as many recorded vulnerabilities as over the past 3 decades, according to IBM. The numbers for last year from the most recent IBM report are also quite interesting. They show an interesting development. The number of breached records jumped significantly. So in 2019, there were 8.5 billion records exposed overall, which was 3 times greater than 2018. But the number of incidents leading to the breach of those records has actually decreased. So this suggests that the number of records affected per breach is becoming greater, or at least has become greater recently. And according to IBM, finance and insurance are the sectors most frequently targeted by cyber attackers. This was the case in 2018, and we're still there. We're still there in 2019. I don't think there are more recent, more up-to-date statistics. But the trend has apparently continued for 4 years in a row now, making finance the most attacked industry. So why the new cybersecurity rules that we see emerging all over the world in the leading fintech jurisdictions are targeting the financial sector? Well, there are many reasons. I'll just flag some of those. We can discuss them in some more detail. These are the assume breach attitude, increasing digitization in finance, and also increasing complexity and interconnectedness of the financial ecosystem. The problem is that finance is rapidly becoming a much more interdependent network, involving a much broader range of actors, not just banks and the big cyber fortresses. And so the risks of contagion are increasing. And so there is a risk that attack on a part of the chain may have repercussions for other entities. And also the cost of cyber attacks is increasing rapidly. Importantly, I have collected some statistics about the breaches within central banks, and central banks are not immune either. And finally, more and more data. So we see the development in the cloud storage facilities, so more and more data is being moved outside the financial sector, with financial institutions only getting access to data stored elsewhere. So there are the risks of data centralization outside the sector, but still greatly affecting the sector itself. And I don't really have a lot of time to cover all of the relevant issues, but I think one important problem I want to flag is the assume breach attitude. That is the expectation that not all attacks can be prevented. This is the driving factor of all cybersecurity regimes right now. The key then is to identify and respond to threats, not to try and prevent them all, which is really impossible. And here you can see a list of recent cyber attacks on central banks, showing well that the problem of who will watch the watchers is also a big issue, and even central banks are not immune to cyber attacks. So one thing one potential issue is the regulation of regulators themselves, keeping track of their cybersecurity. And finally, I want to finish with some key takeaways for the fintech sector. You can see I have a lot of material as usual. Well, I think the biggest problem in this context is that smaller fintechs, especially startups, are particularly vulnerable in the light of the cybersecurity regimes, legal regimes that we have analyzed internationally. We looked at the United States, Europe, Asia, including Singapore, some other jurisdictions that are leading in this field in terms of regulation. For example, cybersecurity rules tend to be abstract and high level. They're rarely specific about the types of defenses that need to be implemented, and fintechs may lack specialist expertise and resources to understand these requirements. They may lack the expertise to decipher the technical standards and translate them into action. And so clear, straightforward cybersecurity requirements may greatly help fintechs to boost cybersecurity. Also, some rules refer to abstract notions like, I quote, latest technological developments or best practices. But how do you determine what this actually means? This really requires expertise. And another problem is that big techs are becoming tech fins, that is, they're joining the financial services sector. And so there is apparently a need for cross-sectoral harmonization of cyber for those big techs. For many fintech firms, outsourcing of cybersecurity could be a source of convenience and specialist knowledge, but again, it could also be a source of vulnerability because many smaller firms will just be using black boxes and will lack the resources to analyze their programming code for vulnerabilities. And the first step was made in the right direction, I think, by adopting the new cybersecurity strategy in August 2020, which promises numerous measures to assist smaller fintech firms to improve cyber resilience. But these are largely organizational measures, and I think that regulatory change will be necessary in the long run. Maybe we'll have time to discuss this in our most in the sessions focusing on cybersecurity. And here is a list of papers. Oh, here are just the two main papers you can find on SSRN. They're publicly available if you suffer from insomnia. And now over to you, Marina or Joni.
Thank you, Anton. So I've got a bit of an echo. Apologies, everybody. Hopefully we can have that sorted out shortly. But Anton, thank you for that comprehensive overview. As the audience can see, we've got a lot to unpack, and that is exactly why we're having this discussion over a 4-part series. And so this being the first, this session, we're really going to try and focus on laying out a brief chronology of the regulatory happenings in Australia over the last few years and how this compares with overseas regulatory reform efforts and the policy positions and trade-offs adopted by Australian versus foreign regulators. And we're going to try and understand some of the current regulatory and cultural issues in the financial services sector that are really stifling our fintech and regtech startups, both pre and post COVID-19. So in our second session, we will be taking a deep dive into central bank digital currencies, and we've just seen the RBA release its report on design considerations, rationales and implications of retail central bank digital currency as opposed to wholesale central bank digital currency. We'll go through some of those foundational definitions in the session. And CBDCs are a subset of what Anton et al. Refer to as sovereign digital currencies. Just making note and paying heed to the fact that not all sovereign digital currencies may be issued or managed by the central bank. The third session will focus on introducing and tightening up of cybersecurity standards and basic requirements for startups and other businesses in the financial services sector, as we saw Anton go through some of the statistics there, as well as some of our recent numbers coming out of the mandatory notifiable data breach scheme, which has highlighted both the health sectors and financial services sector as points of vulnerability, or most attacked sectors. And finally, in our fourth session, we'll tackle the elephant in the room. And Anton, I think you made some pretty strong comments there, which I do agree with. Whether the enhanced regulatory sandbox really is that much better than the old one, and will it be good enough to invite and support Australian innovation in financial services, which is at least at par to other efforts around the world and at least our regional competitors. So there's more coming, everybody, and I would encourage you all to put your questions in the Q&A function. If we can't get to them all today, we will take a record of them and make sure that we address them in future sessions or in content that we produce after this recording, after this event. So Anton, in the last few years in Australia, we've had, and let me keep track of these, a Royal Commission into Misconduct in the Banking, Superannuation and Financial Services Industry, established in December 2017, and the final report was submitted in February 2019. We've had the Productivity Commission undertake a 12-month inquiry into competition in Australia's financial system, with their final report delivered in August 2018, and that looked at how to improve consumer outcomes, the productivity and international competitiveness of the financial system and economy more broadly, and how to support financial system innovation, with the keywords being while balancing financial stability objectives. 3, we've had a Senate Select Committee convened in September 2019 to investigate and report on financial technology and regulatory technology. We've just seen the interim report be released and we're expecting the final report in April 2021. And fourthly, as part of the government's response to the Royal Commission, we now have the Australian Law Reform Commission conducting a review of the legislative framework for corporation and financial services regulation. And of note in this is that the ALRC is not tasked with recommending policy changes regarding the content of obligations on financial services providers, Rather, the inquiry seeks to facilitate a more adaptive, efficient and navigable framework of legislation within the context of existing policy settings. And it is the second interim report, not due until September 2022, that will focus on regulatory design and the hierarchy of primary law provisions, regulations, class orders and standards. And the third report, due by August 2023, that will focus on potential reframing or restructuring of Chapter 7 of the Corporations Act. And fifth and finally, I will pay special mention to the Boosting Female Founders Initiative, where the Department of Industry conducted consultations in 2019 before the first round of grants opened up this year. And submissions received in that consultation process has highlighted some of the cultural issues facing Australian fintech startups, and particularly female-founded fintech startups. So with those 5 things in mind, and with the richness of reviews that we've been able to undertake and are still undertaking in Australia, Anton, how well is Australia's fintech regulatory environment evolving compared to our overseas competitors? Are we getting good knowledge, or are the constant inquiries just slowing us down? I think you're on mute. If you could just unmute.
I was muted by somebody. Thank you.
Go ahead.
Thank you, Joni. So I think this is really a big question. And last year, I spent a lot of time comparing fintech promotion and fintech development strategies in Australia and also in our major competitors in Singapore and Hong Kong, also looking at some jurisdictions in Europe, such as Switzerland. We produced a report which was requested and funded by CPA Australia. You know, the starting point for, it looks like the starting point for most of the fintech studies is how many fintechs do we have, even, you know, to begin with. And so in terms of numbers, just in terms of numbers, we seem to be doing okay, right? So the numbers that were relevant as at end 2019 were roughly 600 fintechs, which seems to be on par with what Hong Kong had, but still far away from the UK with over 1,500. So that's almost three times more. And it seems to be on par with Singapore as well at the end of the year. And we requested the data from the Monetary Authority of Singapore. I went there physically when we could still travel. It was November last year, so it was a very timely visit to MAS. So at the time they told us they had about the same number, but then I looked. You know, with the coronavirus and all of the developments, I don't know what happened, frankly. I don't want to speculate, but if you open the website of the MAS and their fintech, how many fintechs they have, it's 1,000, or it used to be 1,100 fintechs. So they almost doubled the number. I don't know where this was coming from. Frankly, I don't want to speculate, but something may be off with the with how you calculate, with the methodology. Nobody really knows. So it appears to be that how many fintechs you have is really the sort of the starting factor that regulators seem to be really worried about at this point. So they're like, okay, we have more than you, so we are the stronger. But I think, you know, there are long-term strategies. You know, focus on competition. It's everywhere. I just looked at the interim report of the Senate Committee, competition everywhere. And one of the really important, I think, developments found there, one of the recommendations is actually the joint recommendations, recommendation 13 and 14. 13 focuses on competition internally within the country, and the recommendation 14 focuses on measuring our external competitive position in terms of adopting innovation. And on a large scale, we see, so it's not about sandboxes. So for quite a long time, facilitating fintech was often discussed in terms of sandboxes, innovation hubs, but the number of things that are affecting fintechs are much bigger, and the strategies developing fintech talent, funding initiatives that are also, by the way, discussed in the interim report of the Senate Select Committee. They all there, and they were all promised back in 2016 here in Australia, and apparently they not all worked according to the recommendations we can see now. But just in terms of the number of initiatives compared to our to say Hong Kong and Singapore, in particular Singapore, seem to be doing okay, just in terms of a more or less comprehensive approach of how many directions we're approaching this from. So are we tackling only, do we only have a sandbox, or do we focus on throwing money at fintechs? No, we seem to be targeting the fintech space from different directions. At the same time, of course, the funding initiatives, the funding opportunities, some of the funding opportunities are much bigger. In particular for fintechs, they have some really good and complex multi-tier funding initiatives, and Singapore in the middle of the coronavirus had offered certain assistance to fintechs, specifically basically throwing money at the industry as well. So there is a difference, but in terms of the basics, having a working sandbox, and in particular, the simple things for example, the innovation hub, right? One sandbox is just testing, right? Testing with live clients, but an innovation hub is just making the regulator accessible to the fintechs. Now, we could certainly do a lot better, because the innovation hub, which is run by ASIC, it has 1.5 persons really doing all of the work, and you probably all know that one person, and then I presume there must be half just to make it all running. But certainly it would definitely help, at least to me, maybe additional funding for ASIC to make sure that this mandate of making the regulator more accessible and easier to work with, that could work a long way.
Can I interject there? And because I will add some industry insights here. And it's not just access to the sandbox. And perhaps we need better, more comprehensive metrics that our policymakers monitor regularly. And so if it's just number of fintechs, I think that's surface level oversight only, as you'd agree. And what we should be tracking, one of the things that we should be tracking is actual consumer adoption of the fintech innovation. So that's probably the B2C level adoption, because if our consumers, at least in the Australian market, are not adopting the innovation, or from a B2B perspective where fintechs and regtechs are providing their innovation and solutions to the big four banks or the bigger.
Joni, on this one, if you look at the interim report of the Senate Committee, you can see sort of the beginning of acknowledgement of that, in particular in relation to the consumer data right. I think one of the points in relation to the CDR is specifically on that is ensuring that the consumers understand and make use of the possibilities that are opened to them through the open banking. Well, this is really the only implementation we have.
Well, and I have something that will take me a few minutes to explain, but I hope that you understand my point and the audience understands my point at the end of it. I did a little trial over the weekend where I downloaded an app which spruiked that it was best practice privacy and trying to give me control of my data. And in order for me to pull all of my financial, medical, social data into one platform, to see what data I have, they asked for my consent for them to access my accounts on my behalf. Now, at the time, I didn't get any warning to say this is actually, I'm giving my username and password to this platform to be able to pull the data which is, I think, commonly referred to as screen scraping. But in this case, it's the deeper screen scraping, because it's not just a general website. It's actually the information within my account, which is what most fintechs, I think, still would have to do to give you the financial insights from your data. Bear with me. So I've given the consent. I've actually shared my username and password with a third party to be able to pull that information into one platform. The advantage is that I see my data, I can control it. And the benefits, add-on benefits, are that I can choose to share that data with other providers who will use my data to inform their insights, and they will pay me for that, and they will tell me when they are using my data. But back to the original financial, medical, social, I'm not being informed when they're using my data or when they're selling my data for other purposes. So with this little trial, I learned that I do have greater control, but with the way that technology or the regulations are currently framed, I only got a warning from my banking provider to say that my username and password had been accessed for me to use this app about 24 hours after I'd actually given the go-ahead. And so it's that particular warning that should be required when consumers are interfacing with these sorts of apps. And these will be around, I think, for a long time before the consumer data right fully comes into effect, as well as, you know, what's recommended with the future directions inquiry that's going on at the moment. But at the same time, I never got that warning. I'm not required to get that warning. My banking provider is aware of that practice, so gave me the warning. And only after I had set it up was I, for, you know, fearing my username and login details being shared, and for the fact that all of my username and login details are within the one platform, that could be a honeypot risk. And it goes to your cybersecurity point. So we're trying to give consumers greater control, and the interim report, actually, I'm not sure if it was the interim report or in one of the transcripts, but there were no submissions received that showed any evidence of loss or damage to consumers as a result of this screen scraping practice. But where were the submissions describing how it actually works and describing that honeypot risk, for example? And so I really worry about these consultation processes relying only on the submissions received, and we don't have people that are actually in industry directly informing the policymakers that, hey, this is actually what's going on in practice, and this is how our policy and our frameworks need to properly protect consumers. So with that example, I'd just hand it over to you for your comment and what you're seeing in other jurisdictions, particularly how they're handling the implementation of consumer data right like legislation.
Yeah, I am absolutely with you on this point, and certainly the interim report itself seems to be, seems to facilitate more of a cautious approach. They didn't recommend sort of revision of the existing arrangements, maybe waiting for the Scott Farrell's.
Which is due to report this September.
Yes, this month. Yes, yeah. So we're waiting for Mr. Farrell's report on the future of the consumer data rights. So looking forward to that, really. And there were a lot of discussions. I know that there was a lot of work by Mr. Farrell on the issues, particularly because this was really one of the specific matters that were referred to that inquiry, screen scraping. But internationally, it's very difficult, really difficult to compare, because of the approach to well, nobody has a consumer data approach to open banking, really. So we are focused on fintech today, and Australia has a bigger initiative called the Consumer Data Right. But if we are talking about open banking, which was launched in July this year, formally, then it's really only the United Kingdom as a jurisdiction that has followed the same approach, that is a mandated approach, where the government or the legislature is proposing certain rules, and those rules are mandatory for the industry. if you and that there the issue is not resolved either. But you start digging elsewhere. In Canada, it's still in the early stages. In Singapore, the problem is not resolved either, because there's no mandated approach to open banking at all, and to the sharing of data across the sector. So what they did was, so they have this bigger concept of smart nation and smart financial sector, and within it, the regulator, the MAS, actually came up in conjunction with the industry with the initiative to facilitate API sharing. So they produced a report.
And just to challenge you on that, I think our legislative framework requires us to have a mandated consumer data right, because we have a 4 pillars policy which has entrenched the market dominance of the big 4 banks, and none of them are jumping to implement the technology changes required to facilitate open banking. And so, because they've got an entrenched market position, and it has been very difficult for the other banks, and I know that the neobanks are creeping up quickly, but they've got to work out their lending books. So with that entrenched market position really finding its feet within this 4 pillars policy, which the Productivity Commission did say was redundant in terms of the governance and the competition factors already dealt with in other legislation. But unless we mandate a consumer data right, again, requiring an inquiry and then a legislative process, they're not going to act with the speed to market that we're seeing other jurisdictions do, because they're forced to act quickly for competition and what's best. And can I just give some more context on this and then ask for your views, because I think that this is going to be a very controversial point. And it's this approach of best approach for regulatory reform. And so there's 2 examples I'd like to take you through. The first is PEXA's acceleration towards holding a monopoly in the electronic property transaction market. We've just seen the ACCC's weighing into the battle between states over the electronic property transaction market, whereby in an AFR piece by Michael Bleeby in June this year, ACCC Chairman Rod Sims warned that without new rules soon to force competition, incumbent platform PEXA will entrench its monopoly in a sector already generating more than triple the ASX's annual $50 million fees in equity settlements, and that in siding with New South Wales, Queensland, South Australia and the ACT, PEXA needed to be subject as soon as possible to common usability standards that rivals could access access, in contrast to Victoria and WA's position, who want a slower process to examine all possibilities and to make recommendations. So 3 of the states are saying, let's do interoperability and work out the technical way to do it. And if we find that it can't be done, we'll rethink. But the other 2 states are saying, convince us that a move away from a monopoly makes sense. But by then, PEXA will have so cemented its position, its monopoly position, that it'll be game over. So the second example is the already entrenched oligopoly positions of the digital platform giants, the likes of Facebook and Google. And you've mentioned the Facebook effect in terms of its announcement of Libra, of its global customer base of 2 billion plus users. It's global scale immediately. But in Australia, we've had the ACCC Digital Platforms Inquiry to look at the effect that digital search engines, social media platforms and other digital content aggregation platforms have on competition in media and advertising services markets. The final report was published in July 2019, and we now have extremely controversial proposed legislation that would require the tech giants to negotiate with publishers and pay for news content featured on their platforms. This approach failed in Europe, so why do we think we can claim success in Australia? And so with the first example showing provocative leadership by the ACCC chairman in encouraging a rapid approach involving common usability standards, and the second example seeming more like an approach ignorant of Europe's failures and similar to a mandated consumer data right, this is a last-ditch effort approach by our federal government involving the force of law. Do you see there being a middle ground to be found in the financial sector in the absence of the current ASIC chair showing the same provocative leadership?
You know, in the context, I think the immediate issue here is the consumer data right and the open banking, where we see these issues unraveling, and I think that really the big problem is ACCC the right authority to run the show in to oversee the consumer data right implementation, at least in the banking sector. And we see the first signs of it being acknowledged that this is really not the way to do. And I think one of the proposals was to have some kind of alternative body, independent body, to oversee the implementation, to focus these issues, because individually they have, well, the thing that the consumer data right is now in the competition legislation. It shouldn't be a problem. You know, we can make amendments to legislation. It shouldn't be an issue in the long term. But how we manage this, I don't just think that ACCC is the. Sorry, I think Marina was saying something. So I think we need better coordination, really, in the in the short term, straight away. And I'm not sure whether Scott Farrell's report will flag this problem, but the way it is designed at the moment, I'm not convinced that we can address these issues competently. Well,
I think what I would love is to see more provocative leadership from the heads of each of our regulators, and to take a view.
Well, you see on that, each of our regulators essentially has a competition mandate. ACCC obviously has the mandate. APRA, you know, you just look all the financial regulators, right? APRA has had it since whatever. ASIC has received it relatively recently, right? They added it to the ASIC Act several years ago, so it also has to consider competition. They all have this competition mandate, and so they all have to consider the issues. And so now we have this new interim report, which actually argues that that was not really enough, and we need the Council of Financial Regulators, the Mary company together, to also have competition mandate and to think about these issues, but together, because they can't really think about this individually. So I'm with you on that.
It's tough. I mean, but it highlights, and we're running out of time. We've run out of time. But we will be unpacking this in more detail over the further 3 series, and particularly that it's not necessarily just a financial services or a corporations framework that is going to attract and support innovation. It is also the tax mix, R&D certainty, incentives for entrepreneurs, which we also don't have that mix right, and our overseas counterparts are doing all of that other stuff a lot better, which makes those jurisdictions a lot more attractive. So I will thank you so much, Anton, for your rich insights, and look forward to chatting to you in the next series.